Hey you guys, I got a good question in the TSP group on Facebook about something related to the S&P 500 constituents. It's actually from a person in the group who's a pretty experienced investor too. Now, mind you, like I said, those of you guys who know what I'm like with investing, I take more of a macro view. I like to look at the broader index and work my way down to companies that interest me based on what's going on across the wider view and narrow my focus down onto where the strength is. Okay, this other individual, Todd, he's an experienced investor. I've seen him talk in the group before. He actually has a lot of really good things to say stock related. He's one of the guys in there who I actually would recommend people take advice from. Based on my knowledge of stocks, he's an excellent resource. Now, that in mind, though, he did ask a question that I think is a really good question, at least something to learn more about, especially if you have a retirement account and you're investing in stock index funds, particularly one that invests in the S&P 500 index. Which, if you're a TSP investor, that would be the C fund. So I'm gonna go over his question here. I already did answer it to an extent, and it was a comment to my earlier post in that group today. But I'm gonna go into more detail on it and show more. Actually, give you a visual on it with this video here to give you an idea, a much more comprehensive answer on this. Okay. So Todd asks. Question for you, Scott. You mentioned a bankrupt company being removed from the index. What about other companies being that just perform poorly? Is the index scrubbed to these on a regular basis? Many here have posted about buying Carnival, United Airlines, and Marathon Oil. These all sit near or in the bottom 10% of the index weighting wise. If they have a couple bad quarters, most likely, or years, likely, will they get removed? I have to imagine once a company is removed from the index, the stock price would suffer, maybe significantly. Okay, these are really good questions from somebody. I would expect to get those kind of questions from somebody who actually has investing experience. Excellent question. I'm not a know-it-all, but this is something I have. That's a particular area of investing where obviously I'm going to have more expertise than him on, and that's what the point of this video is going to be about. So I'm going to show you just exactly how this works. Now, he did mention, because I talked earlier about companies going bankrupt. What happens when you have a company going, and let's say in the S&P 500 goes bankrupt? Standard & Poor's, S&P, that's the company that manages the index itself. And by the way, an index is just nothing more than a list of companies. It could be a specific number of companies, like S&P 500. It's 500 companies. Those 500 companies all have to are what you call large cap companies, large market cap companies. They have a bunch of different inclusion criteria. I'm going to discuss those right now. Let me pull up the criteria again. You can look here on the. Am I ever going to stop getting messages? Okay, this is not what I'm looking for. I think I'm looking for, Investopedia. They have a more simple answer here. Okay, so here's your list right here. So to be included in the S&P 500 index, the company must have a market cap of $8.2 billion as of February 2019 guidance. It must be headquartered in the U.S. The value of its market cap trade annually. So in other words, there has to be enough liquidity. It has to have enough shares traded to at least equal its own market cap. So just say I got Tesla in here right now on my thing. I'll pull up the summary and I can see what Tesla's market cap is. Tesla is not an S&P 500 company, but I will be talking about Tesla a little bit later here. I just want to show you though, 151.9 billion is what their market cap is. Now, their price, basically divide their market cap by the price, and that gives you how many shares need to be traded daily, or and actually annually, for that condition to be met. Speaking of, what exactly is market cap? That is a measure of the company's stock price multiplied by the available shares outstanding. So for Tesla, their cost right now is $819.42, which is quite a bit higher than I remember it being before. It used to be only like $200 or $300 a few years ago, if even that. Okay, but they have 185.4 million shares outstanding. So what I'm going to do is, if I can get a little bit of cooperation there, pull it up on the calculator so you can see 819.42 multiplied by 185.4. 185.4. No, 0.4 equals 151,920. Now the shares outstanding are in terms of millions, so you got to add extra zeros to the end of that. So you got 6 more zeros to add. So 3 more zeros will put it at 151 million market cap, and then another 3 zeros will put it at 151.9 billion market cap. So that's where that number comes from. Okay. The company has to be large enough, like I say, $8.2 billion market cap to be included. And they have to, and then with Tesla being a $151.9 billion market cap company, then there has to be enough shares traded. They have to have enough liquidity in their share trading to equal or exceed that $151.9 billion. It doesn't matter what the price does. It's just a matter of, collectively, how much is each share being traded for, and how many are being traded overall across the span of an entire year. It should be very easy for companies for large, very liquid companies to do that. Just for the heck of it, let's take a look. Okay, Tesla's 10-day average is 18.3 million shares traded. So let's get an idea. We'll just say it's a $820 stock for roundabout figure. 18.3 times 820. That's 15 billion. So now there are 365 days a year, but you're not going to get that many trades a year. You might get that many days of trading, because their weekends don't count, holidays don't count. So I think realistically it's about 260 or so, roughly, actual trading days per year where they can do this. So I'm going to just multiply it by 260, and we end up with 3.9 billion. So they have 151.9 actually, let's see, no, that might be trillion, actually, that I'm thinking about it. Yeah, it's 3.9 trillion is what actually gets traded. So they are a highly liquid company. They get a lot of share activity. I know a lot of day traders like to trade Tesla, so I'm not surprised that this goes on, because day traders particularly like companies with a lot of liquidity. They try to avoid companies with low liquidity, because as you get what's called the bid-ask price, well, you're not going to get a good bid-ask price right now because the markets are closed. But right here's a good example. Bid-ask price is $819 for the bid and $820.50 for the ask. So when you buy, if you buy it at the market rate, you're buying at the ask price, and then when you sell it at the bid price. Day traders want these prices to be as close to each other as possible. The ask price is always going to be higher than the bid price. But when you take a highly liquid company like Tesla, you're going to have a very small difference here. It's only $1.50 off, which is for $819 share price. That's minute. That is so tiny, very small. Now, if I pick a different company like trying to think of one of the ones that I've been known to trade in the past or liked, NVIV. That's a very small company. It's they deal with spinal cord research, in Vivo Therapeutics. Now they have a $7 million market cap, very small. Now let's just see what just look at their bid-ask price. It's a 3-cent difference, but it's basically a penny stock. It's a $1.44 stock. So if we figure out what's the difference between their bid-ask, 143 and 140, divide that by 140. Okay, so there's about a little over 2%, look like 2.14% difference in their bid and ask prices versus, let's look at Tesla's, 820.50 versus 819. Come on. Divided by 819. You're talking about 0.18%. So the bid-ask price is extremely tight for Tesla because they are so highly liquid, versus you get a small company like in Vivo that has very little liquidity. There's a larger gap. So basically what that means is that the share price has to go up $2, actually 2%, more than 2% on in Vivo if you buy it at the market price or the ask price, whatever. The share price has to go up at least $2%, or actually the bid price has to go up at least 2% before you even breaking even. And for a small company like that, it doesn't move very well. It's more difficult for that to happen versus an extremely liquid company like Tesla. 2% you can get that within a day easily, and it's highly likely where you can get changes like that in any given day with a company like them. Okay, so now let's go back to the point of this question though, because he had asked about companies that don't perform well. Yes, this happens actually quite often, and I will show you this. In fact, this coming Tuesday, the S&P 500 is going to have 2 constituent changes coming up, and I have them already listed here. I haven't updated them yet because they haven't actually been made yet, but you can see right here, these are the 2 upcoming changes to the index. The first one is Dexcom Incorporated, which is DXCM. Delta X-Ray Charlie Mike is the stock symbol in phonetic form. It's a healthcare equipment company. They're going to be replacing Allergan, which is the healthcare company also in the index. The Allergan stock symbol is AGN. Now, Allergan got acquired, as you see here, by AbbVie, which is also an S&P 500 constituent. So because now they are going to disappear because they're now part of another S&P 500 company, they need to be replaced on the index by some other company. So now S&P or Standard & Poor's is going to replace them with Dexcom Incorporated. Now this other one here that's going to be happening on Tuesday will be a much more familiar company to everybody here. Domino's Pizza, DPZ, will be entering the index and replacing Capri Holdings, CPRI, or Charlie Papa Romeo India is the phonetic, or as you see here on the screen. And why that's happening is exactly what Todd was asking. This is because of market cap changes. Now and this happens frequently. Now I'll show you in 2019 alone there were 5 changes like this that were made. So I have them as market cap. I can even filter. I thought I had filters set up. Hang on, let me fix that. Go to data and then filter. Now I come over here to come down here and scroll down to market cap changes, and boom, all the market cap changes that have been made since 2016 are right there. So a good number there. And I see down here at the bottom there have been 18 market cap changes, or at least that I've documented as market cap changes in my spreadsheet. Could have been more that I just documented a different way and just it didn't catch my filter. But 18 of them since April of 2016. 2019, if I just look at a date filter, you get these 5 here. So back in 2019, had Foot Locker, got replaced by IDEX Corporation. Yeah, again, these are all market cap changes. This is Nectar Therapeutics that got replaced by Las Vegas Sands. AMG, I forget the name of them. Let's look them up. Kind of irrelevant information anyway, I guess. Affiliated Managers Group, it's a capital markets company. They got replaced by Live Nation Entertainment. TripAdvisor got replaced in December by Zebra Technologies. The label printer company. I know anybody in the Air Force who works with tool accountability equipment knows all about Zebra printers. And in Macerich, that's an oil and gas company. I want to say oil and gas. I forget. Or are they a REIT? They're a REIT. Okay, I thought it was one of the two. I thought it could have been a REIT. They got replaced by Steris PLC, which basically is a PLC. Usually it's a foreign company, but they have a headquarter in the U.S. still. So those all got made in 2019. And one of Todd's other questions, we can actually address that, and see it actually asked, well, what happens to a company's stock price when it gets removed from the S&P 500, and what happens to that company overall, whatever. So what really goes on here, these companies that join the index are almost certainly going to be promoted from the S&P 400 mid-cap index. So you have a 500 company and then a 400 company, and they switch places. And so the market cap change now. The one that's coming up, I also want to address. Come over here. I can rank them by market cap, which I've already done. So I have these filters. I usually update my earnings data, it's like right here. So I know who's next I'm looking at. A couple of these have already been updated, but regardless. And come over here to market cap and sort it largest to smallest. And I go back down to the very bottom of the list, and here are the most likely candidates to be removed from the index. Doesn't mean they're going to be removed if you see them here. Every company that has a market cap below 8.2 billion, in fact, I can even number filter less than 8. Okay, so we got 83 companies right now with below $8.2 billion market caps. That's a lot, but also keep in mind that prices are still a little low, because of the bear market that's been going on. Can have a lot to do with it. But the bottom ranked company is not always the company that gets removed. Actually, in this case, you see exactly this going on. Capri Holdings, as I mentioned. That's a clothing, obviously an apparel, accessories, and luxury goods categorized company. Okay, so they're right here. They're number 499 in rank. Now, why do I have 506 lines? Actually, one of those, the number one line, row one here, is the header row that tells me what each of these columns means. And so rows 2 through 506 are the actual stock tickers and companies. Now, 5 of those companies in the index have 2 stock symbols. They have 2 different share classes. It's like Google, News Corp, Fox, Discovery, and who's that 5th one? I forget. I forget, but regardless, there are 5 companies in the index that have both of 2 different share classes included in the index and factored into this. So that's why you see 505 stock symbols in here and not 500. There are actually 500 companies, but add the 5 stock symbols, the secondary stock symbols for those other 5 companies, you get 505. Okay. Now, Capri Holdings, they are not the bottom ranked company. So why are they getting removed and not Helmrich and Payne, which is, I believe, an oil and gas stock? I can expand this. Yeah, the oil and gas drilling. Okay, there could be different reasons why Standard & Poor's decides they want to get rid of Capri and not Helmerich & Payne. One, it could be maybe they have too much representation in one particular category. Like maybe they feel like they have enough representation in the apparel, accessories, and luxury goods category, or it could even be, I have to come back in here. That category is in the consumer discretionary sector. Maybe they feel like they have too many consumer discretionary stocks in the index right now, and they feel like they don't want to go down anymore in the energy sector stocks at the moment. That could be one reason. Or it could also be that Capri might have had its certain categories of that make it not eligible for inclusion in the index for a longer period of time than Helmerich & Payne. Now I did look this up, and I figured out from the you have to do a little bit of math here, and I'll show you how you can do it. So Capri Holdings, I'm gonna go to them first. What does it take for them to have an $8.2 billion market cap? They have to. You can't do anything with the shares outstanding. If they issue more, if they do a stock split, the market cap's not going to change. The only way that's going to happen is if their price performance changes. So their share price has to go up to a certain point to get them above that $8.2 billion threshold. So what we need to know is basically 8.2 billion, and then divide that by 149.4 billion. So I'm gonna just go into an unused area of the sheet here. Yeah, just somewhere way down on the bottom right corner. Okay, I'm gonna do 8,200 because I'm gonna truncate the numbers here. As you see here, I got 6 numbers cut off on this too. So 149.4. I could add in the zeros, that'd be 149,400,000, and then, but I'd have to add 6 more zeros to the 8,200 as well. It's just simpler to do this. So I'm gonna do. Okay, so now we know what Capri's share price minimum is, and then if I want to compare it to Helmerich & Payne, what's it going to take for them? Let's look at what HP's. And I'm not the only one who probably thinks that HP, you see HP and automatically think Hewlett Packard. When I first started working with this data, don't worry, I did the same thing. HP, that should be Hewlett Packard, shouldn't it? No, it's not. They are HPE and HPQ, if I remember right. Anyway, they have 107.4 million market shares outstanding. I'm on my Ameritrade account, so this might help you guys out if you have an interest in getting an Ameritrade account, working with Ameritrade's interface, or maybe you're already familiar with using it or already have an Ameritrade account but just don't know too much. I'm trying to point out where you're looking for certain things. Okay, 107.4. So I can just divide that by that. Or to be real nerdy, I can always just come over here and hit F4. And now it adds these dollar signs. That makes it an absolute reference and not a relative reference. So now when I come down here, because the other cell reference here is a relative reference, so now every time I'm going to copy, Control C, when I come down and I paste, it's going to change the relative reference down 1 row, but it's going to leave the absolute reference alone. See? So HP's price needs to be at least $76.35 per share, and Capri needs to be at least $54.88. So I can't guarantee we can get an answer to this. In fact, I already know the answer, but I'm going to show you guys this if you want to really do your research on this. Yeah, because these, if you have any real stock investing interest, you really should be learning stuff like this. It should not just be a simple here, throw your money at whatever company and then just hope it sticks and hope it actually does something good for you. You want to know what you're dealing with. And what Todd asked there is actually a question asked by a reasonable investor who wants to know if maybe a company he could be invested in is in danger of performing even worse in case they actually get delisted or removed from the S&P 500. Excellent question here, and that's why I'm covering this. Okay, so now let's look at these companies. How long have they been below that $8.2 billion threshold? All right, so start with Capri. I'm going to go to my chart here, and I already have HP pulled up. Now, they've been a longer time below their threshold. $76.35 was their threshold, as you see right here. All right, so I'm coming over here. When do they cross below the 76.35 threshold? I can make a price line here if I want. Just for the hell of it, I'm going to go ahead and do one. Drawing tool. Price level. I'm going to come across here. Come on. Okay, now I have a red line going across. Now I'm going to hit it. I'm going to right click and hit edit. I'm going to set the price at the threshold I want it at. That way I know where it crosses, where the last time is it crosses. You see these prices here, looks like they got kind of close, but yeah, now I know I can at least zoom in on that. I'm going to change my drawing though to the pointer. That way I can hone in on this area here specifically. And you can see that the price never gets above the threshold over here, and what's that, as early as January of 2018. I'm looking in the top left. Right below where you see the sell market button on the top left area, there's where it says D. That's the day that I'm actually that my crosshair is actually focused on. See, it goes up to. All right, so it never crossed the threshold. The last time it was above that threshold was here, which was in January of 2017. So it's been below the $8.2 billion market cap for over 3 years now. Why are they still in the index? Yeah, there could be other, yeah, like I say, there could some of the other market cap changes that were made in 2019 could have been for, yeah, it could have been other reasons why they wanted to remove other companies, or maybe the other companies were even lower in ranking than HP at the time, or Helmerich and Payne at the time. Or like I mentioned, they might have had some other factors involved that they discuss in their meetings. The people who actually work for Standard & Poor's, to discuss and vote on or whatever, why this company should go or why that company should go, and then whatever gets the most votes to go is the one that goes. But they have different justifications. Okay, so January 2017 is when they were last at a more than 8.2 billion market cap. Now let's look at Capri. All right, let's get out of there. Now 54.66, no, 54.88. Okay, 54.88 is the price we're looking at. So let's go back to the drawing tool, put another price level in there. Oh, accidentally hit it. Set the price at the threshold. Okay, when's the last time their price was there? It was right over here. Come back and change it to the pointer. And now here's our threshold. Back here in November of 2018 is when they fell below. So they were more recently, they haven't been below the threshold for as long as Helmerich and Payne has. So the amount of time spent below the threshold is not the reason why Capri is being removed, because otherwise, if that was the case, then they would have removed Helmerich and Payne instead. So there's some other factor or factors involved in that decision. All right, so that's a bit of give you kind of, I guess, an intro to how the stock selection process works. Because when you're investing in I mentioned earlier in the other post in the TSP group, how when a company, companies get removed from the index and replaced with other ones regularly. Actually, about 24 every year on average lately. A lot of them are because of acquisitions. They could be because of divestitures that make the company too small to remain in the index, or several other reasons why that can happen. 2019, PG&E, Pacific Gas and Electric, they declared bankruptcy. Yes, they're still in business, but they filed for Chapter 11 bankruptcy protection as a result of that huge fire into the Camp Fire in Paradise, California. The one that destroyed the entire town. Okay, they were basically found to be liable for that because their equipment caused the fire, and so they declared bankruptcy to protect themselves from liability. As soon as they declared bankruptcy, Standard & Poor's, it's an automatic. You're out of the index if you declare bankruptcy. So as soon as they declared bankruptcy, Standard & Poor's instantly went and found another company in the S&P 400 and made the change. Removed Pacific Gas and Electric from the index and replaced them with the other company. All right, so that's kind of a nutshell on all that. Now I do want to also talk about Todd's question about what happens to the company's share price after they've been removed from the index. Is it going to hurt their share price? Yes and no. It may, but it's not a guarantee. Yeah, there are going to be some liquidity concerns about that because obviously the S&P 500 stock index funds get traded a hell of a lot more than, let's just say, an S&P 400 based ETF, which there aren't very many of them out there, but they do exist. Or could be, I don't know, well, let's see, if Capri is a NASDAQ, I don't know if they're NASDAQ or New York Stock Exchange, but you can find that. I can even find them on my own thing. Okay, they are a New York Stock Exchange stock here, NYSE. And even on my spreadsheet, I'm deleting all this because I don't need it, and go back, and I can show you even on my own data, XNYS, that is a New York Stock Exchange stock. This is just here in Excel. Now, there are some stocks in here that you're going to find are on the NASDAQ exchange. See, XNAS, that's a NASDAQ stock. American Airlines is a NASDAQ stock versus Capri and a bunch of others are New York Stock Exchange. Okay, so we talked earlier about how Foot Locker got removed. That's a good one to look at. People know them. So let me look at what day Foot Locker got removed. They got removed in August of 2019. I may need to go back a little bit further, but I don't know. Well, I think the latter part of 2019 was okay in terms of overall stock performance. I don't want to pick a company where at a time where they were replaced at a time when the market's in decline. I want to see one that got replaced when it's literally them just performing badly for their own reason or something, or because they're a group of stocks and not the entire index. So double check. I want to see what S&P 500 was doing at that particular time, August of 2019. That is right there. Now let me zoom in some because I have my price targets here that I use, which I haven't updated yet. Okay, August is right there. So long-term S&P 500 was generally trending upward. It was a down month in August, but as a whole, the index was trending upward throughout that year. So this is a good example to use here to look at Foot Locker. Because if they got removed, we want to see what their price history was doing before they actually got replaced. And then, is there any notable difference in how it performed after it got removed? So I'm going to put FL in here. Now see, they started taking a dump back in April, they topped out in April of 2017, and then they went down quite a bit and then came back up. And 2019, August of 2019 is right there. Okay, so yeah, it dropped, and it probably was, I mean, it could have been, all this volume was more than likely a result of them getting removed from the S&P 500 and changed over to the S&P 400, because that's, like I say, that's what usually happens. An S&P 500 stock will get demoted to the S&P 400 mid-cap index, and then an S&P 400 stock will get promoted into the S&P 500. So you're going to see more volume and volatility normally at that time. As you see here, So you got the volume numbers down here. So there was a spike in volume there, and then it settled back down to more normal range. So that was expected, but then it trended upward over the next few months, a couple of months, and then I see it kind of trended back down, or it's more like a sideways trend, I would say. Actually, technical chart analysts will actually see this as it got into a bearish wedge. So you got this blue line here, it's a 200-day average, and then you got the red line, which is my 10-day average, and or actually 10-month average, because I have it on a monthly scale. So basically, it got into this little wedge. The 10-day was coming at 10-month average kept coming down, while the 200-month was trending slightly up. I got into this little wedge and it started ping-ponging in between the two, and then it broke to the downside. So that's what a technical chart analyst and trader will actually be looking at. These kind of things here. Get in a bearish wedge, usually this is exactly what's going to happen here. When it gets to the end of where it gets squeezed into the end of the wedge, it goes to the downside. And versus a bullish wedge, it looks the opposite direction, where it might be flat, straight across on the top half, and then you'll have a rising line at the bottom. That's a bullish wedge, and that'll be more likely to break out to the upside. Just something else that might help some of you guys who are into trading or investing, whatever. I don't like to make investment decisions based on technical indicators, but technical indicators like these are actually good for helping you decide when you want to buy or sell something you already have in mind to buy or sell. I wouldn't use these as specifically as, oh, I'm going to buy this because it's in this formation. No, a better way to invest is pick something that you like for a particular reason based on fundamentals, and then use these technical indicators here as tools to help you decide when to make that kind of a move. Now, and these indicators are they're not foolhardy. Just because it broke to the downside here doesn't mean the next time that you see a bearish wedge with it, doesn't mean it's going to break out to the downside again. It could go upward for all you know. Okay, so you got to watch out for technical analysis. It is not 100% foolhardy. If it was that easy and simple to do, trust me, everybody would be making a ton of money off it. But there's a reason why traders, less than 1% of all traders out there actually outperform the S&P 500 when it comes to trading index funds. So don't get too caught up in that, but don't discount them either. They do have some valid points on at least when you should consider doing one move or another as a possibility. So anyway, overall here, it's with Foot Locker, yeah, they're trending downward since, but how much is that based on technical chart data? How much of it is based on their own fundamentals? Because you can't discount that. Let's look at Foot Locker here. Okay, what's going on with their earnings? That could be telling some clues here. All right, so I have it by quarter. I'm gonna switch it to annual, and we can see what their annual numbers look like. When I see their earnings going up at the same time their price is going down, well, they are expecting a drop now, but how much of that's also factoring in this COVID-19 stuff that's going on? So the price has gone up, or their earnings have gone up at least a little bit, and they're dropping a lot here. And these are all, they've not reported earnings yet this quarter, and that's going to include some of the COVID-19 factored stuff. So what drop you're seeing here in the coming quarters probably has COVID-19 written all over it. Otherwise, they're mostly flat to a little bit on the positive side, which is actually not bad. So again, why are they trending downward over these years? There's something going on there in all likelihood. Maybe somebody doesn't like their management, or maybe they see something in their their fundamentals here, the balance sheet, or cash flow, or something. That can be given little indications that areas of concern. Okay, the simple way to look at this, I'm going to dumb this down, and I'm not an expert by any stretch on these microeconomic things either, but you can look at these. They have cash and short-term investments. It doesn't look bad. Total debt looks consistent. Total equity looks mostly consistent. Nothing really concerning there, but you'd like to see total equity going up. Total debt, you don't really want to see it skyrocketing, but you don't necessarily want to see it go down to zero either. I mean, zero is a good thing as far as companies' ability to avoid bankruptcy, because they don't have debts to worry about. But they have much less concern about them going bankrupt. They at least wouldn't have to fork out all of their assets, their equity value to lenders, if that's the case. But having some debt actually does help them leverage their growth. Like a good example came up in Ancora a few years back. I remember reading, someone had asked, is it better to buy a $300,000 house, or should I take my $300,000 and pay $150,000 down on two different homes, and then have a couple of $150,000 loans, and then rent two houses out, which that's called leveraging. You'll have payments to make on both, but you can probably rent the house out for both houses out for more than what your mortgage payments will be on each of them, and you end up pulling a profit on them, and then as well as on top of that, maybe the value of the home will also appreciate over time, and if you decide to sell it, there's more income there for you as well. So that's what you call leveraging, where you can increase your income and revenue stream by borrowing money from lenders, whatever, to create more revenue sources. So large companies will do this a lot, like Foot Locker or anybody. So don't be too concerned about debt, but you don't want to see that they're incurring more and more debt and going more, they're declining in cash or declining in revenue, or their total equity is dropping. Those are red flags. That should be alarming. Okay, I'm not going to go into the tables there because I don't want to overly complicate this, but at the very least, just look at this stuff. Okay, total revenue for Foot Locker, actually pretty consistent there, maybe a little bit up. As you see here, total revenue is actually up to $8.005 billion, which is better than any of the previous 4 years. Operating income kind of up and down, I guess, but a little bit down. That could be a concern. Total net income trending kind of sideways across the board. It's been up and down a bit, maybe slightly down. I don't really see anything actually alarming there, to be honest with you. Just looking at face value here, I'd have to dig more into the weeds there to figure out what's going on. But total cash from operations, it's kind of trending down a little bit. Cash from investing, as you see, it's pretty far negative back in 2018, and it's trending upward now. Same with total cash from financing, also most largely negative in 2018, but trending upward. So, do I think Foot Locker, does their price really need to be as low as it is? Is their decline in price justified? I don't know. I'd have to look even more deeply at this. What kind of news is going on with them? But I can't positively determine that their removal from the index has anything to do with their price continuing downward. And also, like I said, their price seemed to be trending downward before they even got removed from the index. So they didn't get removed here, but they've been trending down for a while longer. There's something more going on there. More I don't know about, and that's one of those, if you're an investor, look at these. Why is that going on? Sometimes there's a good reason for it that you just have to figure out, and sometimes it's not a justifiable reason, and maybe they could be a good value. So looking at this, yeah, it's a possibility that Foot Locker could be a good buy at this point. Maybe it's just technical driven movement there, and an otherwise good company. But they could have been trending downward mostly, I would say, because of the decline of the mall. Brick and mortar malls, of course, we all know they've lost a lot of prestige because of Amazon and e-commerce. So I would say that's more likely related to an extent, but still, if that was the case, then why is it not showing up in their earnings? There's something that investors are seeing up ahead or something, or they're seeing that's already in their data that they don't like. So you gotta, as I say, I'm not gonna keep beating on this, but you gotta do your homework if you really want to know that you're investing in the right company for the right reason and at the right time. Okay. That should cover that, I think. Let me double check that I got all of Todd's questions addressed. I need to go sit refresh. Now I got to go find his question again. Yeah, I'm going to wrap this up pretty soon here, but I just want to need to find my. Why am I not seeing it? Okay, how about come back to the top? Oh, okay, right here. I skipped it. All right. Okay, so as far as Carnival, United Airlines, and Marathon Oil are concerned, let's see where exactly they rank in there. Now, mind you, it's not always the bottom ranked company in the index that gets removed due to market cap changes, like I showed here. Capri is not the bottom ranked company, and I have seen other cases where companies ranked a little bit higher in the index are still removed. So they don't even have to be in the bottom 5. They can be up a little bit higher. Anything that meets that, or the criteria that meets some other things that they're looking for. Let's see, the first one he mentioned, Carnival. Okay, so let's look where Carnival is at. Okay, I see a Marathon over here, ranked 479, or well, actually 484. So they're definitely down in there. But now, the energy sector already got beat up pretty good in the index in 2015. There used to be 40 companies in the energy sector of the S&P 500 back in 2014, and they got down to less than 30 now. And that's probably why they don't want to worry too much about energy. Okay, I know why. There are only 10 companies there are 10 energy sector companies with market caps below 8.2 billion. But if I want to know how many total there are, now I usually had another table in my other spreadsheet I used to use that shows that how many are in each sector, in each group, and all that. But the spreadsheet tended to be a little slow to perform at times with a lot going on. So I try to simplify this now. Energy sector, we have 27 stocks now. Like I said, back in 2014, there used to be 40 of them, and then they just gradually fell by the wayside when the energy sector recession happened in 2014 and 2015. And as companies kept their market caps kept dropping and dropping. They were having too much influence on the broader index. They decided, let's get rid of these, the worst of these energy sector companies, get them out of the index and replace them with companies that might be that might make our index perform better than it has been. So that's part of their selection process. So maybe they feel like there are already enough energy sector companies removed from the index. Now, consumer discretionary, you're going to see here, I think it's about 76 or something around there. 64. Okay, down here I got 64. And then how many apparel coming into the sub-industry, and then so you got apparel retail also, but I just want to look at the apparel, accessories, and luxury goods. You got 8 companies just in that subgroup. So you got VF Corp, Ralph Lauren, Under Armour, okay, seven actually, if you include the fact that Under Armour has 2 share classes. Tapestry Incorporated, PVH Corp, Hanes Brand, and Capri. So, and of course, Capri is the worst of those of that particular group, or smallest, I mean, not worst. Okay, but Marathon, as you saw, it's in a group that maybe they've decided is already beat up enough. I can't guarantee they won't be removed, but there's a possibility they could. They're, you know, how much danger are they in of being removed compared to some of these other companies? I really couldn't tell you. They say the board that handles the Standard & Poor's board that handles this constituent changes, they have a number of different reasons why they might pick one company or another, and I don't know all the factors they look at personally. Okay, next one had United Airlines and Carnival. Where is United? I can search, but now United is actually larger, has a better market cap than American Airlines, as you see here. So let's look at all the airline stocks. American is an industrial. I'm going to go ahead, that way I have a smaller group to look at. And it's a little easier for me to find a United that way. Okay, so United's up here. The 442, ranked 442 in terms of all the stocks or the symbols, versus now Alaska Airlines, as you see there. Alaska Air Group is the bottom ranked out of those, and American Airlines is larger than larger than Alaska, but which, yeah, no pun intended there, I guess, but smaller than United Airlines. So when I say United Airlines is in danger of being removed from the index, I would say not. I would be more willing to bet that American or Alaska would be removed before United, personally. Doesn't mean that either one of them will be, any of them will be removed, but now let's take a look at their market caps. Okay, United's market cap is not too far off it's 7.3 billion. And it needs to be up above 8.2. How much of that? Yeah, how were they up above 8.2 before this drop? Let's figure it out. They have. I'll come into Ameritrade again. Okay. 290.4. I'm going to use the calculator this time. 8,200 divided by 290.4. Yeah, 290.4. So their share price would need to be at least $28.23 for them to have a market cap in excess of 8.2 billion. Their current price is not that far below that. So it's at 28.23. Let's go over the chart. Let's take a look at it when their price dropped. They just dropped very recently. They were well above that point in time, so I would say it gives them it's less likely, in my opinion, that any of the airlines, or at least not United Airlines, at least, it's less likely that they're going to get removed in the near future if they were well above that 8.2 billion threshold before, and they only dropped because of the COVID-19 situation. They're going to probably recover in due time. It might take a while, but they'll recover. I would imagine. So, I would not make any bets that United will get removed from the index. I would bet again. I would put money down that they will stay in the index more than anything. Again, I'm not the expert on that. I'm not part of the Standard & Poor's board, so don't know for sure. Now, the last one he asked about, Carnival. That's a cruise line company. I think that's consumer discretionary. hotels, restaurants, and leisure. Okay, so here's Carnival. Now, if you see here, Norwegian Cruise Lines and Royal Caribbean are actually smaller than Carnival. So, again, if it's going to be a market cap situation that gets a cruise line company removed, I think it's less likely that Carnival will be removed than Royal Caribbean or Norwegian. But again, I'd have to look at the price behavior, the history of all three of those companies to get a better idea for sure how likely. But you would rationalize that the smallest of those three is, if they have a reason that they have too many cruise line companies in the index, and maybe they want to trim that down, and I would think they'd want to get rid of the smallest of the three more than someone else. But like I said, the price performance history can also factor in, because maybe the smallest one looks like it has a better chance of recovering or improving its performance, versus one that's larger and might be trending downward and they have reservations about. So, like I said, there are a lot of factors in there, but that's the way I see it. I hope this answers all of Todd's questions. Make sure I have all that covered. I do remember I did want to talk about Tesla though, because there have been questions before about why are they not in the S&P 500. I want to go to make sure I've addressed all of Todd's questions first before I do that though. Okay, if they have a couple bad quarters, most likely or years, will they get removed? That's a possibility, because if they are negative in earnings, they can get removed just for the fact that they might not have positive earnings performance. But there are companies like HES, HES, pull them up. How this company is not bankrupt and is even still in the S&P 500 is I can't figure out. This company's been in bad shape for years. I'll show you their earnings. So they've been underwater for a few years here, and doesn't look like anything's going to get any better for them. Even when all the other oil and gas companies were doing well or better, these guys were still putting out negative after negative after negative earnings. Like, how in the hell are these guys even still in business? I won't touch these guys I won't even put $1 into these guys of my own money. I'm not saying, but other people might see other things and have other reasons to believe that they're worth holding. But again, there are things that even I can't understand. Again, a company that's performing like this, why are they still in the S&P 500? And then what is their market cap? Just out of curiosity's sake, $14.9 billion. So they're actually above the threshold, but they're below as far as the earnings. They aren't meeting the earnings performance criteria. That's for darn sure. But once again, as long as their market cap stays above 8.2 billion, I'd say there's a less possibility that they're going to get removed unless they are acquired by another company or they go bankrupt. That would be my guess. So it's just one of those examples. Even I can't figure these out. There are other reasons why companies stay and others go. So things that make you go, I guess. Now, I think I forgot. I want to double check that I got all of Todd's questions addressed again. Okay, so could the stock price suffer? Let's take a look at a couple of these other constituent changes. Nectar, NKTR. You know what? Let's go back a little further than 2019. Actually, I want to go to someone who to a company that was replaced prior to that. How about Chesapeake Energy, CHK? Let's just see what they're. Okay, what day was that? March of 2018. CHK. Let's see what the price. and that's not very liquid there. You don't see much price movement. Not much change in from top to bottom every month either. So it's probably not a very liquid stock. Now, March of 2018, that was right there. So, looking at this, their price actually went up after that. So, this is definitely at least a clue that just because the company is removed from the S&P 500 doesn't necessarily mean that its price is going to drop. Because, like I say, their shares will get sold off out of the index funds that are S&P 500 based, but they're let's just say it could be dropping into the Russell 2000 or NASDAQ, or NASDAQ they might already be in, so it might not affect NASDAQ index funds. But maybe it could be in some other index-based ETF that maybe not quite as liquid, but they'll still have to buy shares back of it in that site. So yes and no. It may affect them negatively, but it won't necessarily. As you can see here, they trended upward for at least a few months, and then they continued downward. And I'd have to look more into the details of Chesapeake to know why they're going down in value, continuing there. But we do see at least a few months of good price performance immediately after the change happened. So I hope that answers your question, Todd. Hopefully it's good information for anybody who's has any kind of interest in stocks and wants to learn more. I'll have this on my YouTube, so anybody on YouTube and in the group, my TSP groups can actually see this and get to know better. Now I wanted to talk about Tesla, because like I said, there were questions before about, well, why aren't they in the index? Okay, come back to Tesla first. Let's look at, are they large enough to be in the index? The answer is resounding yes. 8.2 billion. Look here, that 151.9 billion. That's a pretty large company. Where would they rank in terms of overall? Okay, let me clear the filter. Alright, is that all my companies? Okay, now, don't care about sector data. Do care about market caps, though. I already have it sorted by market cap, so now let's see awareness group, awareness list, Tesla falls. Now, while I'm at it, you're probably wondering, why are some of these companies highlighted with that peach color and why are the others not? The ones that are peach colored are the Dow Jones Industrial Average stocks. All 30 of the Dow Jones Industrial Average stocks are in the S&P 500. That's why I always wonder, why in the hell are you guys all following the Dow Jones Industrial Average? It is a worthless index, in my opinion. It is not a good economic bellwether. A company that has all 30 of those and more, an index that has all 30 of those and more, is going to be a much better economic bellwether than just that group of 30. And as you see, large companies like Amazon, Alphabet, Facebook, Berkshire Hathaway, MasterCard, AT&T, those are all large companies, and they are not even in the Dow Jones Industrial Average. Also, the DJIA, whatever, or the Dow, as people like to call it, that was originally an index designed to only follow companies in the industrial sector. So, in other words, out of all the S&P 500 companies, only 30, okay, come here to the industrials sector. You see there are 11 different sectors here that are all listed right there. I got 71 companies in the industrial sector in the S&P 500. You would think that the Dow Jones Industrial Average would be 30, probably the 30 largest of these companies. But as you see, that's not the case here. We got 4 companies there. Any others? No. Okay. So only 4 industrial sector companies are even in the Dow Jones Industrial Average. What's wrong with that picture there? Yeah, it's an index. It was originally intended to represent this sector specifically, and now you have a lot more companies that are not even in the industrial sector than you do in the industrial sector representing that index. Something else wrong there. Okay, but that's an aside I just wanted to address, because I know some people are probably wondering that. Now, coming back to the question at hand, where does Tesla rank in this entire list? Okay, 151.9, they would be right there. They'd be right above Eli Lilly and right below Salesforce.com. As you see there, Eli Lilly is the 36th ranked company, so Tesla would be ranked 36 out of 500 in the S&P 500 if it was in the S&P 500. So why is it not in the index? Okay, their market cap is large enough. Problem is their earnings are not, and they have to have at least 4 consecutive quarters of profitable earnings. As you see here, most of it's shares in the public's hands, which I never finished talking about. At least 250,000 of its shares trade in each of the previous 6 months. No question about that they meet those. At least a year since its IPO. Yeah, that's no problem. The sum of the previous 4 quarters of earnings must be positive, as well as the most recent quarter. Okay, so the sum of the previous 4 quarters of earnings must be positive. Now let's take a look. I'm already on Tesla. Let's look at their earnings. And I'm going to put it into my spreadsheet just so I can have it doing the work for me. Now, where did they first go positive? It was right here. So let's go back over here to 304. I'm going to come back down to the very bottom, and we'll just pick some spot down here out of the way. Yeah, right there. Okay, I'm going to put these quarterly earnings in here. Oh, it's negative 304 actually. Negative 304. 335 and 306. 290 and 193. Then you got negative 290 and negative 112. Looks like 186 and 206 positive. So it's looking better for them. 124 was their most recent one. They just reported a couple weeks ago. And then looking forward to, now let's see what we have there first. Because it has to be the most recent quarter has to be positive, and the sum of the 4 quarters. So let's see if that's enough. I'm going to do equals sum of these. Okay, so they are not positive there. They're not positive there. They're not positive there. They are positive there, but it's not a positive quarter. That was negative 112, so they were positive on the 4 quarters, but negative on the most recent quarter. So, okay, now it's negative for the 4 quarters, but positive for the quarter. Still negative and a positive. Okay, now we have just enough. Now we have the criteria met as of their most recent report or quarter. So their 4 quarters combined and the most recently add up to $4.04 per share in earnings, and the most recent quarter alone was $1.24. So I'd say there's a pretty good possibility that Tesla could be the next company, or one of the next companies you see joining the S&P 500 if that is the case. Now they might still want to look at what's going on further up ahead too. We'll just put it in there just for the heck of it. Negative 151, 144, 261, and 193. Okay, so this all looks good here. Looks like we're going to see a decline in their earnings over the next couple of their 12-month earnings over the next couple of quarters, which, like everybody else, that's COVID-19 related, and then they should be going back up and then even hit new highs with their earnings a year from now. So it looks good for Tesla. I say I wouldn't be surprised at all if you see Tesla get added to the S&P 500 in the not so distant future. Now, going back to my my rant about why do people even care about the Dow Jones Industrial Average? I'm just curious, just so you can see, where does Tesla rank in terms of Dow stocks? You would think that Dow stocks would be the top 30 stocks in the S&P 500. No, that is not the case. As you see here, you got 3 of them right there that are near the top that are not even in it. Amazon, Alphabet, Facebook, and Berkshire Hathaway. Actually 4. Those 4 companies are ranked 3rd through 6th in terms of market cap in the S&P 500, but none of them are even in the Dow Jones Industrial Average. So we have 36 would be actually right there would be where Tesla ranks. So what I can do here, actually, I'm going to apply the color filter here. Okay, so how many of these companies are below that rank? I have a total of 12 here that are smaller in size than Tesla. And that this is the entire list of Dow Jones Industrial Average stocks here, by the way. And you want to see what kind of representation they got? There you go. They're all over the place. Here, let's sort this by A to Z. Got 1, 2, 3, 4, 5, 6, 7, 8, 9 different sectors involved. Only 1 material sector stock, which is Dow Incorporated. Only 4 industrials, which is what it's supposed to be focused on. Figure that out again, I don't know. Anyway, that's kind of a nutshell what I was wanting to get at with all this. I hope you guys got a lot of good information out of this. Don't hesitate to ask questions or post whatever comments, any kind of feedback. I'm all for positive, negative, whatever. But I said my focus is on the broader index mostly, and then I narrowed down to the individual company stocks from there. If I do invest in companies, I do tend to prefer the futures market more myself. But that's just a personal preference. I do like individual stocks as for certain different types of companies for different reasons, whatever. But all right, so that's enough. I hope you got a lot of good info out of this. I don't care if you like or subscribe, whatever. Just as long as you got some kind of value out of this, it's all good. You don't have to communicate it. All right, guys. Thanks for watching.